Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome to Coasting in Retirement. Thanks for joining us today. Josh Knoll here alongside co-host Michelle Lee Melton-Knoll. Michelle, how you doing?
I'm doing all right.
Yeah.
Looking forward to celebrating America's birthday.
Well, that's right. Yeah. So, if you're tuning in, this is the celebration of American's birthday. Yeah. Happy 4th of July weekend. Michelle and I are here we're working hard. Coastal College's recording studio, beautiful downtown Fairhope. Hoping to put together another great show for those of you tuning in. Listeners, Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store. First segment, we do a deep dive on our topic of the day. Second segment, roughly 30 minutes past the hour, we have headlines of the week. And then roughly 50-ish minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. And this time, my big mouth was pretty accurate pretty quickly.
We'll see about that.
We'll see about that. Either way, buckle up. We got a lot to get to. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I am a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We do have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com. And we got a new site launching next week, by the way, Michelle.
Ooh, la la.
Yeah, or feel free to give us a call, 251-327-2124. If you just missed that contact info, grab a pen, grab a pad, grab whatever you write on. We're going to repeat it several times throughout the show. So for today's episode, we're going to start with a trope that our industry uses over and over again. Have you ever heard of in our industry, have you ever had a salesperson say, oh, you're going to get to the top of the mountain, but how do you get back down?
No, when I was reading this earlier, I really don't know what that means.
Well, give it a few years, and if I'm not watching out, there'll be some advisor try to talk to you about this. The trope is, and it's a trope for a reason, because it's kind of a mental picture of what happened. You've climbed the financial mountain and you've reached the top, woohoo, right?
Sure.
And now you're ready to retire.
Yeah, well, I'll just stay up there though.
But how do you get back down the mountain without falling off? That's a great point. In this example, you've spent 30, 40, maybe 50 plus years focusing entirely on accumulation, i.e., going up the mountain. But but the day you retire, that game completely changes to distribution, i.e., going down the mountain, right?
Oh, okay. I can see that, but I still don't like it. And the trope looks a lot like tripe.
Got it. Well, frankly, Michelle, many investors and honestly, many advisors, not only is that analogy or metaphor or whatever you call outdated, they also use outdated math. They use 1990s math to try and help navigate some of these.
I wish it was the 90s.
This retirement. Basically what you're trying to do when they're saying how do you get back down the mountain, they're trying to put together a retirement income plan. So especially for those of you all used to a regular paycheck, which I haven't had in 20 some odd years. Michelle's always had.
Bi-monthly.
Right. The shift to you're making your own paycheck in retirement is probably the most psychologically jarring part of retirement, right? And for you self-employed people, that's obviously, I was in my mid-20s. It took a little getting used to not getting paid regularly, but sometimes people get scared and they tend to kind of gravitate towards simple all or nothing formulas. Maybe they heard it on a podcast or YouTube or read it in a magazine, whatever. So what we're going to do today is help you cut through all that clutter, and we're going to discuss the 4 different retirement income strategies, i.e., how do you get back down the mountain, and help you decide which one might be the best for your situation. All right, you got it, Michelle?
Sure.
Okay. So we're going to keep things pretty simple. And I'm going to say something.
Simple. That's good.
Yeah, we're going to keep it, this is radio. We can't show charts or anything. We based our calculations on a hypothetical $1 million portfolio.
Tiddlywinks.
So we're going to that's a nice portfolio. So we're going to use $1 million. We're going to take that $1 million and look at the potential income produced from 4 different sources, and those sources are purchasing an annuity,
Duh.
living entirely on dividends, dividend-producing funds and stocks. the classic 4% withdrawal rule. And then number 4, what some advisors would call dynamic guardrails. It's got a way nerdier name than that, but dynamic guardrails. We'll get more into that. And a quick note, some of the projections that we're going to be using, they're going to be based on timing, and they're going to be definitely market dependent on taxes. For example, on the annuity numbers we're giving you, insurance companies often change their payout percentages based on current interest rates. So take our projections and our examples with a little grain of salt. They're meant to be a general estimate to help us do a compare and contrast. Also, before we dive into each individual scenario, I think it's fair to give credit where credit's due. We definitely used he's a financial advisor. I don't know him, but his name's James Cunnell. He's at Root Financial, and he's got an excellent catalog of videos. He's not anywhere near here. I think he's in the Northeast, so I don't think anybody listening to the show is going to go to him. But point being, he's got some great videos, and he really helped with putting this episode together. So credit where credit's due. If James is tuning in, which he's probably not. So that said, let's look at our different approaches. Are you ready?
I'm ready. Okay,
so the first example that we are going to do is putting the $1 million into Michelle's favorite annuity
called the SPIA.
To say anyway. What is it? SPIA, the single premium immediate annuity. Now, some of you all that are pretty savvy in our industry, or you're in our industry, you may be wondering why are we picking a SPIA? Why are we not doing a deferred income annuity? Why are we not doing the soup du jour of a fixed income annuity? Again, we're just trying to give a compare and contrast, because even though the numbers that are going to be on this payout for the SPIA will vary some among the different types of annuities, which we're going to circle back to later in this episode, they're still going to be somewhat in the same ballpark. Annuity payouts don't differ radically. And if you had something that's way, way higher than what we're about to tell you, it's probably projected to nonsense.
Yeah.
It doesn't mean anything. So we did what we did. And again, we're keeping our examples simple. So for those of you all that are trying to figure out how do I produce income in retirement, we're using a SPIA, a single premium immediate annuity, as our first example. That means you place one large premium, or maybe a couple of large payment premiums into this annuity. And generally speaking, it's immediate, which means you're going to kick on the income stream relatively immediately, right? Mm-hmm. We base our numbers on a 65-year-old male. Here's the math. So again, this will vary by insurance company and by the month. It just depends. But what we generated, that this thing was going to kick out somewhere around $6,500 a month, pushing right at $80,000 a year, which would make sense, because that's going to be somewhere, if you do the math, back into the math, that's somewhere in the neighborhood of a high 7%, maybe low 8% payout rate. Does that make sense, Michelle?
Yeah, I mean, it's math. I get math.
It's math, right. So you place this premium, especially with any of y'all that have sat through illustrations and not insurance illustrations, the immediate annuity and the single premium immediate annuity and the deferred annuities, these are very simple illustrations. Here's your premium, here's your payout, right? Now, there's choices you got to make that's going to determine that payout. But as opposed to sitting through a fixed index annuity illustration, or Lord help me, a variable annuity, those can get very complicated. SPIA is very simple. So what's the pros of that, Michelle? Let's ask you, as somebody that's always had a regular paycheck versus me, what would be some pros of, hey, you're giving me, this salesperson $1 million, and I'm telling you, I'm going to give you $6,500 a year for the rest of your life.
Yeah,
what say you?
I mean, that sounds good at first blush,
okay.
right?
Yeah.
Yeah. I mean,
does it give you peace of mind?
Yeah, but things change, fluctuate.
You know enough about this business through the show to know that. Okay, so here's the pros. There's total peace of mind. You know what you're getting, right? You're creating a pension type income.
I don't
plan.
know if total would be the right.
I understand.
Peace of mind
for the right person. That's right. Yeah, we're not trying to sell these things. There's literally zero market risk, because you have taken that $1 million completely out of
the
any
market,
right.
Yeah.
And you are getting, sometimes we're going to talk more on this later. Annuities get a bad rap. But if you're with a reputable insurance company, which the majority of them that are in this space are, you're getting a guaranteed paycheck for life. If the insurance company says that they're going to pay you the rest of your life, it'd be a rare case where that actually didn't happen. And then the cons of it, the pro and cons, as Michelle alluded to, what are you actually getting into? There's no inflation adjustment. Mm-hmm. So the purchasing power, something that we talk a lot about on this show, right? Purchasing power has eroded. I mean, purchasing power has gone down over a third just since COVID. So what is the value of your dollar? Yes. So what's going to happen in the next 20 or 30 years? That $6,500 in 2026 may not sound super strong in 2036.
Correct.
Or 46.
It might not be around.
I'm saying we're assuming The insurance company pays it for the rest of your life.
Okay.
But let's say you live another 30 years and now you're getting $6,500 in the future. That might have the purchasing power of $1,500 if you're lucky, right?
Yeah.
There's in this example we used a life only example. So there's zero legacy value for your heirs upon death. When you pass away in this scenario, the money just stops coming. And then probably as important as anything, there's zero liquidity. You know, if you need a lump sum, like buying a car, major medical bill, there's no way to take it out once you do these income annuities. Now, again, some of you all that are in the industry, you're hollering at me on the radio that what about fixed index annuities where you can get 10% surrender free every year? Yeah, I hear you. And we're going to talk more about that. And also, some of you all that are familiar with this, I did a life only. Of course, you can do joint life, you can do survivor benefits, all that. But anytime that you do something that extends the potential of exposure of the insurance company, well, guess what's going to happen to the payout? It's going to go down, right? And that's across any annuity. Okay, make sense?
Yes.
All right, so that's what we got. All right, let's skip on down to number 2, the strategy. These are 4 strategies for producing income in retirement. First one was utilizing the annuity.
SPIA.
Yeah, or any annuity, but we'll talk more about that. Second one is living on a dividend-producing stock and fund portfolio only. Okay, so again, keeping the math simple, you put $1 million into a stock portfolio or a fund portfolio with the intention of producing some kind of dividends. Now, savvy investors, especially you all that are kind of DIY, especially any of you that are bogleheads, will say, well, what if we're trying to produce dividends off of really low-cost S&P 500 index funds? Well, the problem with your S&P 500, because it has shifted, so many companies inside the S&P 500 companies have shifted to more of a growth factor, and it's really heavily weighted to tech. Consequently, when you have a growth fund or a growth stock, they're not necessarily pumping out profits and in the form of dividends. They're reinvesting. A lot of times they're not even making a profit, as we've seen here recently with SpaceX. So if you looked at the current dividend yield of the S&P 500, it's a little over 1%. So math is easy, right?
I can do that.
Yeah, 1% of $1 million is $10,000 a year.
But that doesn't sound great.
No, it's terrible.
It's not good.
But I mean, again, it's intentional. So what we're going to do for this example is we're going to assume a 2% dividend yield,
oh,
right?
Wow.
But even still, that only generates $20,000 a year.
That really is still tiddlywinks.
Right. So you all know, any of that y'all are trying to have a retirement, $10,000, $20,000.
66.67 a month.
That's not much, right?
Yeah.
Yeah, versus the $6,500 from the previous example. The pros and cons. The pros are you never have to sell down your underlying shares because you're basically taking profits off the table is what you're doing. It kind of gives you a safety barrier, if you will. Okay. The cons can be pretty extensive here. One, obviously, $20,000 is not enough. Now, let's say you try to get a higher yield, 4 to 5%. In doing so, what you're looking at is you're going to be chasing a lot of dividend stocks, or maybe you're mixing in a lot of REITs. The problem with getting some of those, outside of just some illiquidity that comes with those higher dividend-producing yields, is that you are going to probably put yourself in a situation where there's not as much upside appreciation capable on those stocks. Does that make sense? So, or let me put it this way. Well-established, think Walmart. Yeah. Walmart is well-established. And of course, Walmart's grown quite a bit and done very well, but let's do Coca-Cola.
Yay!
Yeah, well-established.
I'm invested in that, so I actually have stock in Coca-Cola, not Walmart.
There's growth to be had with Coca-Cola, and usually it's growth in like energy drinks, but I'm saying about this Coca-Cola, the drink. For it to grow, normally at this point, it's got to take market share from Pepsi or some other soft drink, right?
Warren Buffett drinks about 5 or 6 cans a day.
Well, I mean, hey, he must got something. He got something figured out.
Yeah.
But the point being is Coca-Cola, very steady Eddie, and so they don't necessarily need, if they're generating profits, they're not looking for massive growth of a younger company. They're going to produce a higher dividend and throw in profit share with the company, right?
Yeah, that was a little foreshadowing for later on.
That's right. Now, if you have a bunch of really strong dividend-producing stocks, it may give you comfort because you probably are not going to see as much volatility in your portfolio.
That's nice.
But in general, it's going to historically underperform the broader market because you don't have enough allocation in growth and things like growth in tech stock. Make sense?
Yep.
Okay. And so and a lot of people do this. Again, there's a combination. I mean, we're not going to get into this. This will be a later episode, but there's structured notes. There's all kinds of different things that are out there, especially for you high net worth investors. We're mentioning them. We're not recommending them because those are a double-edged sword, a lot of those products. but we'll come back to it. What we're talking about is just normal dividend-producing instruments, CDs, money markets, REITs, dividend-producing stocks. Generally speaking, what you're trading off for that relatively consistent cash flow is upside appreciation, and generally speaking, the dividend produced a lot of times is not high enough to cover what you're trying to do with your income needs in retirement, right? Mm-hmm. Okay. In fact, I think if you look, I don't have the numbers in front of me, but if you look at the last 15 to 20 years, dividend-producing stocks have massively underperformed the broader S&P 500. So there's math back up to that, okay?
Okay.
All right, let's get to number 3. Number 3, a lot of people will recognize the traditional 4% withdrawal rule.
Is 4% still good, though?
Well, we're going to talk about it.
This day and age? Okay.
We're going to talk about it. So this was a study, oh my gosh, I should know this. It was 1960s, was it 1990s? Whenever Bill Bingen.
Allocation model from the 1990s.
Thank you. Yeah, it seems like it's been around longer than that. But Bill Bingen did a analysis. What he did is, if he took the historical returns of the market, I know what it was. He took the historical returns of the market over many decades, and he said that if you were a retiree living through all these different decades, what is the lowest number that you could safely withdraw percentage-wise out of your overall investment portfolio without completely depleting your savings before normal lifespan? That makes sense?
Yes.
And what he landed
What
on
is it?
What he landed on was 4%, right?
Okay.
So on $1 million, again, we're keeping the math simple.
Yeah, 40.
$1 million times 4% is $40,000 a year, right?
Yep.
And then what Bill said in his example was, we're not just gonna do a flat $40,000 per year. We're actually going to adjust for inflation.
Okay.
So you can already see where this has got a little bit of a leg up on maybe the dividend-producing portfolio, right? Mm-hmm. And of course, it's very simple. It's very easy to understand. It was used for years, if not decades. It leaves the portfolio pretty highly liquid. The cons of it, and especially over the last 15, 20 years of the stock market, is that it's really designed, like I said, it's designed to be a worst-case analysis. And it incorporate things like the Great Depression or 1970s stagflation. And not that those things can't happen again.
Right.
But the overall majority of retirees end up radically, they did the math, they end up underspending their wealth.
Blow that stuff up.
And they end up dying with more money than they started with as if they were in a well-diversified stock-based and mutual fund.
I can't take it with me. Forget it.
Right. You want the last check to bounce, right?
I mean, sure, why not? I don't have heirs to deal with.
Or
so.
like they say in the country, they say, I'm not going to leave too much wood on the front porch for that next guy. So
nobody knows what you mean.
Yeah, there are people listening know exactly what I mean. So they with this, a lot of times you're not optimized. Now, if you're a pen and pincher and you're proud of how you save money, this might be, and especially if you want to do it yourself.
I mean, this sounds like something you would do. So would you have more? You'd have more money to leave to your heirs.
I mean, maybe, and I am relatively frugal by nature. Right?
Correct.
Yes. I do have certain things that I'll splurge on, but yeah,
I am not.
Yeah, we are opposites attract. Like who sang that song? Opposites attract. Yeah,
Paula Abdul.
Thank you. Yeah, Paula Abdul. Random Paula Abdul reference here. All right, so we've got, let's sum it up before we get to our fourth one. So we're looking at 4 different ways to generate income retirement. The first was annuity. Now, of course, if you're with a really slick annuity salesperson, they're going to convince you that's the only way, but we're going to, as we've doing here, we're walking you through all these different things. Number 2 was using dividend-producing portfolios, try to produce some profits or some interest or some yield. Number 3 was the 4% rule, keep it simple, stupid, basically, right? Mm-hmm. Number 4, this one is where we're definitely gonna get a little nerdier and a little inside baseball into the weeds. The research we did calls it dynamic guardrails, and I've heard it called that before. Kind of, it's fine. There's an underlying study that was done, and I'm going to mispronounce this guy's name. It's either Guyton or Guten.
I think Guyton.
I think it's Guyton
Klinger.
Yeah, Guyton Klinger, which real nerds like me will reference Guyton Klinger. And basically what it does, it says that we're going to leverage broader asset classes and we're going to use modern portfolio rules. Right, to help us back into our withdrawal rate, okay?
All right.
So here's the math on it. When you are looking at a Guyton Klinger, and if Guyton is listening, if he's still alive, and I'm mispronouncing it, I apologize. But basically what you're doing is you're agreeing, like in this $1 million, you're saying, I agree, the investor, that I'm going to make adjustments to my income needs, slight adjustments based on market performance year to year. And I'm going to have, we just started earlier, guardrails. I'm going to have a low point, of a dollar amount that I need that I cannot go below. And I'm going to have a high point that once I reach, maybe I turn off the spigot for the year, right?
Okay. All right.
And so for this example, again, this is just math, simple math. If we start that $1 million, we're looking at a 5.5 initial withdrawal rate. That's $55,000 a year. And what that does is obviously $55,000 versus the $40,000 or whatever.
$20,000.
You get a higher initial lifestyle bucket, right? Mm-hmm. Use rules. Inside here, you're going to look at selling asset classes that have performed well. You're going to take some gains off the table. You're going to let your other stuff cook that needs to cook. But this is everything I'm telling you here is you've got a low point. I've got $1 million. And as anybody has ever invested knows over the long run, they always tell you, well, the market does 8-9%. You'll hear different numbers, but 8-9% every year. Well, what they don't tell you is rarely does the market do 8% in every one given year. That's just an average. Mm-hmm. So you'll have years where the market does 20%. You'll have years where the market's down 5%, up 3%, so on and so forth. So what this does, this allows your portfolio to be flexible with what's going on with its actual investments, but it does require active management. It's not the simple, stupid, set it and forget it that you would see with the 4%. This requires usually some professional guidance. If you cross that negative guardrail, you must be willing to temporarily freeze your adjustment or maybe even cut your spending. So you want to make sure you set that appropriately. And then conversely, if the market booms like it has the last couple of years,
yay!
Right, you can give yourself a little bit
more money.
Yeah, you can relax a little bit. So the thing is
sports car.
Now. What I just that's right. Yeah, we're working on it. The thing is, if it's all about being proactive and having a rules-based playbook. So what I just told you with this, it's not where we're in a lab doing chemistry with beakers and things and mixing them.
That'd be more fun.
Here's 6.2% for the year. How it is applied in a practical sense is the majority of financial planners I know use some type of financial planning software. The big names are Money Guide Pro. There's good grief. There's a couple of them. We use a company called Right Capital, like your right hand. They're fantastic. It's really easy to use. Clients love them. But inside there, it allows us to monitor and work with our clients on the income that they're producing out of their portfolios. Because the one thing that's great about the guardrails theory is it reflects the fact that your income expenses are going to change year to year. Mm-hmm. Very few people, and I mean very few, spend almost exactly the same amount of money every single year in retirement, right? Because things break. You need to get cars. You have medical expenses, travel. There's just different things. You're going to be in a range, and depending on that range and how your portfolio is doing, if you're not paying attention to it, if you got a couple years where maybe you spent a little bit of excessive money and the market was down, you're looking now at a drawdown risk, and that's something that needs to be managed pretty proactively. These are the things that we can do with our financial planning software. Does that make sense?
Yes.
Okay. Any questions on that part?
No.
Okay. So the point being is, it's not necessarily just because I say, hey, we're going to put some guardrails here and some targets, that just automatically solves the problem. What it does, though, is it gives us the ability to use our financial planning software combined with our human experience and some common sense to help you establish a range. That way, if things start getting out of range, we can have a conversation about some of the things we need to do, especially around some of your assets that we're investing. The majority of the time, and one of the takeaways as we start finishing this segment, is that your bigger danger is when you're trying to generate income, that most people, they almost focus too much on the number, if you will, Michelle. The actual monthly number,
right,
or what it may be. Okay. I mean, it's important to have, don't get me wrong.
Right.
But what they fail sometimes to look at long term is if you are trading too much certainty and too much comfort, if you will, to generate that number, sometimes you are leaving two large potentials off the table. One, that your portfolio won't keep up or beat inflation over a long period of time, and two, that your lifestyle may have to be dramatically reduced due to inflation 10, 15, 20, 30 years from now, right? Those are your two real downfalls on that. So what we do is we are going to look at being in things that have the ability to outpace inflation, not necessarily guaranteed, but have the ability to outpace inflation. And then we're going to manage that to produce an income stream. And then we're going to manage the underlying asset. Like Michelle said, if she wants that last check to bounce, and maybe some other people want to leave all kinds of money to the heirs, whatever you want to be, we have the ability to turn the knobs and twist the dials to get you where you want to be, especially if you just want to blow it out in retirement.
Blow it.
That's right. Because a lot of times sometimes people will be so, I've seen this, Michelle, they'll be so frugal in retirement that they'll get towards the end of their life and they start getting unhealthy and they have all this money and now they're too sick to spend
do
it.
anything with it. Yeah.
Right. That's right. All right. Well, listeners, if you want to set a follow-up...
Not me.
And I don't think that's going to be a problem for you. Listeners, if you want to set up a follow-up conversation with us and the team at Gulf Coast Financial Advisors, it's very easy. You can give us a call at 251-327-2124 or find us on the website, gulfcoastfa.com. So that's Gulf Coast and then FA as in financialadvisor.com. On the site, there is a blue button in the upper right-hand corner that will put a meeting on my calendar. You can choose 3 simple ways to meet. We can do a 15-minute introductory phone call. We do a 30-minute Zoom, or our preference, let's meet in person. We have 3 office locations. We're in downtown Fairhope. We also have an office in Orange Beach, just down the road from the wharf off Canal. And we have a 3rd office over in Mobile. It is near the intersection of Dolphin Street and I-65. However you reach out to us, make sure you do. We'd love to meet with you. Our folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles relevant to those of you in or near retirement, and we give your honest opinion about these headlines. Join us after the break to hear Michelle and I discuss this week's relevant news in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting Retirement. Your host, Josh Knoll, here alongside co-host Michelle Lee Milton-Knoll.
Howdy.
So as we discussed before the break, every week we scour the internet for financial articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these articles and headlines impact you, especially when it comes to your money. Now, quick note, if you want to read our referenced articles yourself, we do include the hyperlinks in our show transcript, which you can find on our website, gulfcoastfa.com. Just go under the podcast tab and then find the episode that you want to re-listen to. Look for the transcript. Look for the article links there. All that said, without further ado, here's Michelle with the headlines of the week.
Okay, our first article is from Money Talks.
Money Talks.
News.
Yeah.
That was my AC/DC interpret. Is that impersonation?
Come on, is that?
Yeah, that's
I
right.
like it. Very good.
Yeah. Okay, so Money Talks News. Yes, titled "The Pros and Cons of Taking Social Security at 62." This article walks through the standard trade-offs we hear about all the time. On the pro side, it highlights claiming Social Security as soon as you can and getting immediate cash flow to fund an active early retirement while you're still healthy, preserving your investment portfolio so it can grow untouched and minimizing the risk of leaving money on the table if you have a shorter life expectancy. On the con side, the big hitter is that permanent benefit reduction up to 30% of if your full retirement age is 67, along with the earnings test penalty if you keep working and potentially lowering the survivor benefit for your spouse. Ew.
Correct. There's a lot of things that go into this.
Right. From a real-world planning perspective, Josh, how do you help clients look past the basic math, which we've covered, of a break-even chart to figure out what actually makes sense for their specific retirement blueprint?
Well, it's something we spend a lot of time on, as you can imagine.
Yeah.
Right?
I think most people want to leave stuff for their spouse.
Oh, for sure. Yeah. And when you pick, depending on when you trigger your own is going to determine
how much they get.
Right. Yeah. So I will tell you, every time I see an article frame it as a break-even chart math problem, it's just not. It's not that
Josh
simple.
is not going to start taking Social Security at 62.
No, I'm not. But that's me.
Yeah.
So we have these. Again. We use our financial planning software combined with our real-world human experience, having done this, I don't know, hundreds of times at this point, and then some common sense to your particular situation. If you're very, very, very sick and things aren't looking great, well, we're going to turn that thing on. You can't.
Sure. Yeah.
The math may not account for some things that are really happening in your life. The thing is, though, it's almost always presented as an individual race against these actuarial tables. What I mean by that, if you live past age 78 or 80, Well, delaying to age 70, then that quote unquote wins, right?
Sure.
Because you get the maximum benefit. And I've said this, there's two things that are relatively unique about Social Security, and hopefully those continue through our political system that's not done a great job of really funding it well. The two things that are indisputable about Social Security is right now it is designed to increase by 8%, actually 0.125 per month, every month that you delay it up until it maximizes out on your benefit at age 70. Two is it is the single greatest destruction of poverty in the elderly population experiment that's ever happened in the history of mankind. It just is. So it's really important that not only they figure out how this keeps going, but it's also important that you pre-retiree, figure out when is the best time to take advantage of this thing. So the article, it mentions, let's look at a couple details here. It mentions earnings tests, but we got to emphasize just how brutal that earnings test is. If you take Social Security at age 62, but you keep working a part-time, like a consulting gig or maybe running a small business, the IRS will literally claw back $1 for every $2 you own over the threshold. And the threshold's not super high. I don't have it memorized, but it's not super high.
No, I was just looking at it the other day.
You are just taking a permanent 30% haircut of the benefit. You're actually giving it back to the government while paying ordinary income tax on your earnings.
No, thank you.
Right? And so that's one. I mean, most people know that now. It's funny. The education on Social Security, because it's become so precious, I would say, there's just a lot more education out there. I guess maybe information's just easier to find. But most people understand that there is definitely an incentive if they want to keep working. And part of it is, Michelle, I know everybody says it. Nobody ever said, well, I feel my age or whatever. We are 100% younger in our 60s than the generations before us.
Correct.
People are
living longer, for sure.
Longer. So there is an incentive for someone that has still got the wherewithal and the ability and the opportunity and the desire to continue working in their 60s. If you can delay it, then once you hit age 67, your full retirement age, some of y'all are 66 years and 10 months, just look at your projections on SSA.gov, but once you hit that, then you have the ability to take your full Social Security out, and IRS doesn't care how much you make. You can make a lot of money. So you get that benefit on top of there. Of course, you're going to pay income taxes, but you get the idea. And then let's look at the math where it might fail with looking at married couples, okay?
Okay.
Social Security isn't just an individual stream of income. It's kind of the ultimate form of joint longevity insurance. So if I'm the higher earner in a household and I claim at 62, I'm not just shrinking my own paycheck. I am permanently capping the survivor benefit for you, Michelle. If I pass
for that person's spouse, not me, because you're not retiring at 62.
Well, no, heck no. I may never retire. But you get that. Those y'all listening, you are permanently reducing that survivor benefit, delaying the higher earner's benefit to age 70. And I'm not saying this is right for everybody.
Sure.
But if you do that, that guarantees that the surviving spouse steps into the absolute largest possible inflation-protected paycheck for the rest of their life. Make sense?
Yes.
Okay. And then lastly, this was from our research. It says instead of treating Social Security as an isolated cash cow at 62, a modern 2026 blueprint looks at using pre-tax IRAs or 401ks as a bridge during those early years. Sometimes you'll hear some people they'll use the term Social Security maximization. I've used it in the past.
Okay.
Now, just to be fair, I've seen that used sometimes as an excuse to sell an income annuity, which is not necessarily the worst thing. But there are things if you
Social Security maximization.
Well, here's a neat little thing for you, Michelle. Again, not to oversimplify it, but if you're trying to get from 62 to 67 and you've got a lot of investable assets, particularly qualified plan investable assets, i.e. 401k, IRA, if you got enough to carve out, you can do a little 5-year payout annuity.
Sure, yeah.
Right? And it can pay and it can get you through.
Your bridge.
And when that annuity runs out, and then you can kick on Social Security. I'm not saying that's perfect. I'm just saying that's
it's an option.
It is an option for sure. And we looked at that in the first. So I know for a lot of y'all claiming at 62 and your buddies, your buddies are telling you how they took it because it's going to be running out and all that, and they need to get it. I know there's absolutely social pressure to do this. Point being, I know it feels good and there's social pressure to do so, but if you don't have the ability,
do the math.
If you don't have the ability to project it out and look at the pros and cons, then find a financial professional that does.
Might be in a world of hurt.
Yeah,
later on.
You're talking about potentially hundreds of thousands of dollars in differences of benefits.
Yeah, and it's so sad to think of elderly people not being able to live well.
Well, the elderly, off the top of my head, Michelle, 86% of statistics are made up on the spot, so take this with a grain of salt. The elderly poverty ratio was somewhere around 2 out of every 3 elderly person in America was in poverty in the 20s and 30s. And after this, I think it's somewhere around 10%, not to make light of it.
Yeah, but I think about my grandparents, though, that are passed. I mean, they had, once my grandfather died, my grandmother had to move in with my parents because there was...
It still wasn't enough.
No,
yeah,
right.
I agree. Yeah, my grandma and grandpa had to raise pigs and do all kinds of stuff in retirement to supplement Social Security. Mm-hmm. All right, very good. What's next?
Okay. So our second headline takes a step back from the typical news cycles and looks directly at an incredibly thorough public policy piece by the American Academy of Actuaries.
This is a good one. Though.
It's an issue brief titled, "What are the various types of insured annuities?" Now, on the surface, a paper written by actuaries does sound like a snooze fest. It is. If you have insomnia, you start reading this and
but this is important. Good. This is one of the very well done.
But it hits on a vital problem. The word annuity is thrown around as a single catch-all term, and it causes massive confusion for both consumers and financial professionals. The brief breaks down the entire insurance landscape, specifically separating the vehicles meant purely for accumulation, going up the mountain, like variable annuities or fixed indexed annuities, from vehicles designed strictly for income generation, like the SPIAs and DIAs, deferred income annuities.
Right.
They dive deep into the math behind payout choices, illustrating how things like, quote, life only versus, quote, period certain, or, quote, cash fund features fundamentally alter your monthly paycheck you're going to end up with.
Right.
So in our opening segment, we use SPIA as our annuity example, but can you walk listeners through how these different types of annuities might affect their hypothetical $1 million portfolio?
Well, I mean, longtime listeners know we can be pretty tough on annuities on this show. Or more specifically, we can be pretty tough on the Slick Rick annuity sales guy trying to cram as much as your money into one to increase his commission. But to be fair, a lot of people selling against annuities on the other side of that, they'll just say, well, all annuities are bad. That's like trying to use a Porsche Boxer to haul a load of dirt or tow your camper and then...
I will never do that.
Yeah, and then proclaiming all of vehicles are bad. It just depends on what type of annuity you bought and, more importantly, why you bought it. So let's look at it this way. If you take that $1 million that we've been talking about and you go down the accumulation path, so in this paper, and I know, Michelle, the whole tee up of this, I mean, it sounds like we're really inside baseball.
Yeah.
But the paper itself is actually very well structured. The PDF, it's very well structured and easy to follow along. And I think it's important, because, again, we don't necessarily recommend any of these products one way or the other. We just try to call balls and strikes. But if you're going to call balls and strikes, you at least want your audience and anybody that we're meeting with to understand the difference between these different types of products, because they serve radically different purposes. I mean, you're talking about the difference between a Porsche Boxster and a Ford F-150. I mean, they both are vehicles, but they do very different things, right? So if you're in the accumulation, you're looking at a fixed index annuity or maybe a variable annuity, you aren't actually turning on a permanent lifetime paycheck on that on day one. That's not the point of those. Instead, what you're looking for is tax-deferred growth. For example, with the fixed index annuity, the insurance company is going to track an index like an S&P 500, which is the most common. It's going to cap your upside, but it's also going to guarantee, it's going to have a 0%, zero is your hero, if the market tanks. The trade-off on those caps is that you're going to seriously limit your growth over time. It's going to have a hard time keeping up with inflation. But for those of y'all that are looking for something that at least has a little upside potential and definitely has some downside protection, that's one. You also, but with those, you got to be, especially the fixed index annuities and the variable annuities, be very careful about strict surrender charges. Don't ever sign anything over 10 years surrender, ever. Now, if you flip to the income generation path, like Michelle's mentioned several times now, the SPIA, single premium immediate annuity, you're strictly buying a pension-like income. In fact, a lot of pensions are funded by insurance companies through annuities. A lot of people don't realize. You can have somebody sitting there drawing a pension from Transamerica, and they can tell you, I hate annuities. Like, well, buddy,
you're living them.
You're living them, right? You give up. The problem is with the SPIAs and the deferred income annuities is you're giving the insurance company that $1 million permanently in exchange for your cash flow. Now, if you're worried about passing away early and having the insurance company keep all your money, then you definitely want to have something besides life only, right? You want to have 50-50 joint heir, whatever it may be. This paper walks through the typical choices that you have. The guarantees that if you die before you get your $4 million back, you want whatever's left to go to your heirs. The catch is the actuaries remind us that every time you add a guarantee like that, your monthly payment is going to drop, right? So the bottom line for listeners is very simple. If you buy an annuity for accumulation, don't expect it to give you the highest guaranteed income stream, right? It's a different job. You're buying a truck, but if you're looking for a car, buy a car, right? If you buy for income, understand that more often than not, you're permanently giving up control of that capital. Now, of course, again, those of y'all that are really astute in the industry or in the industry are saying, well, hey, we can take certain types of annuities and annuitize them. Yes, I understand that. But the point being is when you're turning some of the things over and you're generating that income, you are losing a certain element of control and upside potential. These are single-purpose, very specific tools. And if you don't know exactly which one you own or you need to own, you can completely derail your retirement distribution blueprint. Got it? Yeah, we don't want that.
No.
All right, one more?
Yes, our final article today comes from Morningstar. It's titled How Retirement Income Guardrails Can Ease Clients' Worries. According to this article, for decades, the financial industry has treated the 4% withdrawal rule like it was carved in stone. But Morningstar points out a huge flaw with the fixed spending rule. It completely ignores what the market is actually doing. If the market crashes, you overspend and trigger a severe sequence of returns risk. Sounds awful, which is just a fancy way of saying you're forcing yourself to sell stocks while they're basically on a fire sale.
Right.
So if the market skyrockets, a fixed rule forces you to needlessly underspend, meaning you miss out on taking that dream family trip while you still have the health and energy to enjoy it. Now, for those of you listeners that check out our show transcripts and read our referenced articles for yourself, I will tell you this one is very, very dense.
It's dense. Yes, it is. I think they all are, right?
Right. It's pretty heavy. I mean, because it's math, but math's math. I mean, math's got a math. So, in fact, all the articles I found about this method were pretty complicated, like we were saying. So, anyway, so you should call Josh to get him to help you with them.
This is true.
So, so with that said, Josh, how do you take into account all these formulas and methods to help your clients formulate an income plan that they actually understand?
Yeah, so again, the technical term for these guardrail type thing is the Guyton-Klinger research.
Guyton-Klinger.
And I don't.
That sounds like a hormone or something.
I mean, Peyton probably. I bet you that I'm going to ask him next time.
If they have a newer.
Well, yeah, if they have a newer, or if he's getting taught this, because when I had him on the show last couple weeks ago, a lot of things we were talking about, they're still teaching, which made me feel good, right? Yeah, we talked about how to value stocks, and they're still teaching some of this stuff. I didn't feel like a dinosaur. Anyway, back to this. So if you read these papers, anytime you're trying to do your own research on this, which I recommend, but it's filled with formulas, it's got capital market assumptions, it's got probability math, and some of it can make it look a little rocket sciencey. Our job, our job is not to hand the clients like a 50-page calculus textbook. Our job is to build a plan that makes sense and reduces financial stress in retirement. So, for example, when a client sits down with us, we'll talk about some probability coefficients. We'll talk about some math probabilities, generally speaking, using our financial planning software. But then we're going to apply a whole lot of life and professional experience. I've been doing this a long time, combined with good old common sense. I think I got a pretty good dose of that. The real magic of all of this it's not just that the math lets you safely start retirement with a higher lifestyle budget than the old 4% rule. The magic is it's psychological. It means that you've got a plan that is going to be on its toes and able to pivot and move when you need it to pivot and move. That's the most important thing. Don't get too hung up on the percentages because it depends on the individual situation. So when the media, for example, when the media is screaming that the sky is falling, our clients don't panic. They don't wonder if they need to cancel Christmas or a trip or anything like that, because when you have a comprehensive financial plan, and this is really one of the true value adds that our business brings to the table, it takes the abstract fear of the unknown and it replaces it with GPS coordinates for your financial journey in retirement. Very good.
All right.
Okay. All right, listeners, you want to set a follow-up conversation with us at Gulf Coast Financial Advisors? It's very easy. Give us a call, 251-327-2124. Go to our website, gulfcoastfa.com. On the site, there is a blue button in the upper right-hand corner. That'll put something on my calendar, 15-minute phone call, 30-minute Zoom, but let's just meet in person. I mean, those other two things are fine, but come on. Let's meet in person, like old school. Downtown Fairhope in the Portico development. We're in Orange Beach, down the road from the wharf. And then we have our third office over in Mobile. It's near the intersection of Dolphin Street and I-65. It would be on the northwest corner of that intersection. However you reach out to us, make sure you do. We'd love to meet with you all. All right, coming up next, Josh's Crystal Ball and Big Mouth. What have been some of my predictions? Have I been right? Was I ever wrong? How wrong? What are things going to affect investors in the near future, or maybe the distant future? We talk all about all these things and poke a little fun at my big. Not this week. We ain't poking fun at me this week, Michelle.
That's right. You got a winner, yeah.
I got a winner. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Null, here, joined by co-host Michelle Lee Melton-Null. So I'm opinionated. I have strong opinions at times. You don't believe me? Just ask my relatives from my recent Table Rock Lake trip I took. I offered my opinion unsolicited across the board on many things.
Last day.
Sorry, Cousin Mark. I'd say a radio show host that isn't opinionated would probably be very dull to listen to.
For real.
And of course, I'm paid in my profession to offer professional guidance and opinions to my clients, not give them always "it depends" as an answer. Let's just get at it. So I like making predictions. Sometimes I hit the bullseye. Sometimes I swing and miss. Let's see what we got this week with Josh's Crystal Ball and Big Mouth. What you got, Michelle?
All right, Josh. As I very well know, anybody else that knows you, you don't like standing in lines.
Negative.
They're not much for being stuck in crowds.
I think that's a fair statement.
Yeah.
Yeah.
Or an airplane.
Or an airplane. Anything that mechanical that I got to depend on keeping me alive, I'm out.
So it was no surprise when you declined to have your clients jump on the recent SpaceX IPO.
Yep.
And I know a lot of people called about it.
I mean, relatively speaking, yes.
Yeah.
We're
I know friends of mine that are your clients.
You're right.
Called you about it.
It had more interest than any other IPO
Correct.
that I've ever dealt with.
Right.
By a margin.
So the stock debuted at $135 a share, valuing the company at a staggering $1.75 trillion, making it the biggest IPO ever. The stock surged 19% on day one, closing around $161 and pushing the valuation past $2 trillion. A few days later, on June 16th, it hit an intraday peak of $225.64.
Yep.
Well. Right after hitting that peak, reality set in. Investors actually started reading the S1 prospectus and... Is it prospectus?
Prospectus, yeah.
Okay.
You said it right.
Okay. And looking at what SpaceX absorbed when they merged with XAI back in February.
Formerly Twitter, by the way.
Right.
Okay.
It turns out that while the Starlink satellite business is a beautiful, profitable cash cow, and pretty cool, the AI side of the house is burning cash like rocket fuel.
Right.
Like SpaceX. Nearly $1 billion a month. Dang, dude, that's a lot.
That's a lot of money.
$1 billion a month?
$1 billion a month, just on the AI. Yes.
Lord. Okay.
All right.
Because of that, the momentum broke, obviously. The stock dropped 3 sessions in a row, and as of this recording, it has pulled back sharply to around $160 a share. Listeners, don't get too attached to that number. The stock jumps around more than a Jack Russell searching for his ball, true life story, or when the alarm goes off in the morning.
Yes,
it's like a Mexican jumping bean.
He does his little shake.
Oh, my gosh. So you nailed this one so far, but what's your prediction for where this is going? Should investors always steer clear of SpaceX or not, or what's going on?
Well, yeah, so I got to be quick because we're running short on time, but the main takeaway is this. Even at 160, it's going to take a long. No one can ever tell you what a stock is worth in the future. And the majority of the time, if you looked at the last 100 years of the stock market, Michelle, the majority of the time, most high-flying stocks were overvalued in that moment. They were. It's a forward projecting looking market. It always is.
Right.
So this is looking forward on SpaceX, and it's saying right now that it thinks it's going to be 160 a share. Where I would argue is it may some point get to that, but I think it's going to take longer than what the bulls are thinking they can get this thing to quicker. Now, of course, any of y'all that are really fans of Elon's investing magic know that he has defied gravity around Tesla and some of his other stuff for years. I mean, he's literally bankrupted short sellers from his ability to keep the share price high. So all this, we're not saying that it's junk or not. Some have some value. What we're saying is be careful when you see an investing crowd, when you see everybody running for one particular door. Man, unless you're at the front of the line, it's better just to wait, let them all flood back out, and find the last guy coming out, and then buy whatever they've got at the biggest discount that you can. That's really how you're looking at doing it for long term. So no, I'm not saying they should always steer clear of it. I just told my clients and anybody that asked.
Let's just see how this pans out.
Let's see how this pans out. Yeah, and you're welcome to do it on your own, but this is not how we do things. We look at real value, and we don't mind projecting value into the future. But I think it's going to be a long time before. I mean, as we discussed on the show last time, Michelle, this thing is trading over 100 times price to sales. Over 100 times price to sales, which in itself doesn't sound like a big deal, except when you figure that the rest of this S&P 500 averages around 4 times per sale. So it's 25 times greater valuation compared to what the rest of the S&P 500 does.
Yeah.
So there you go. Thank you. The crystal ball was right.
Yeah, good for you.
There you go. All right, well, listeners, I hope you enjoyed a little peek in how we form our opinions and make predictions. We invite you one last time. If you'd like to have a no pressure, no obligation conversation with us about your investing goals and retirement dreams, give us a call, 251-327-2124, or go to a website, put something on my calendar. Let's meet in person. 3 office locations. We're downtown Fairhope. We're in Orange Beach off Canal Road, and we also have a 3rd location in Mobile near the intersection of Dolphin Street and I-65. Please reach out to us. We would love to meet with you. That's our show for the week.
That's it. I hope everybody had a great Independence Day.
That's right. I want to give a huge thank you.
250.
That's right. I want to give a huge thank you to my co-host, Michelle. Thank you.
Thank you.
Thank you to the producer of the show. That's my son, Peyton Knoll. Thank you to our show sponsor. That's Providence Partners and Mr. J. Stubbs. Thank you to our awesome radio station. That's FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music. That is local band Sloth Racer. As always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be a part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.